Welcome to Funds Transfer Pricing. This short opening shows the problem we will solve, the price structure you will build, and how to choose the right depth as you move through the course. I'm André Camata, a quantitative analyst at BNDES, Brazil's National Development Bank. My work centers on funds transfer pricing, building FTP models, and pricing new products. The standard I care about is practical. A model should make its assumptions traceable and improve a real decision. FTP has no single universal calibration, so we will be clear about every choice the framework makes. You need some fixed income intuition, discounting a cash flow, reading a yield curve, and recognizing that tenor changes value. If that feels rusty, the curve lessons rebuild it carefully. You need working intuition here, not a library of formulas. You should also recognize the basic bank book, loans on one side, deposits and other funding on the other, with net interest income between them. Regulatory acronyms help, but they are not prerequisites. We introduce LCR and NSFR first. IRRBB and credit parameters arrive where they become relevant. On the code, the engine is real Python, and it ships with the course. The calculator and the lab notebooks both run in the browser if you want to start there, and the same package installs locally the moment you want to point it at your own balance sheet. Start with the profile, the contractual terms, then how it reprices, and what the customer can choose to do with it. The profile is what the price follows, not the product name, since two contracts wearing the same label can pay down on quite different schedules. How finely that grid gets applied is the bank's own call. A common route is to price by product and tenor band rather than deal by deal, since a bespoke number has to survive the systems that bill it. The deal-level read then earns its keep in the report, showing which exposures drifted from the band they were priced in. Those inputs activate cost and risk drivers. The reference curve establishes market time value. The liquidity layers then show what committing funding for a term costs and what standing ready costs. Losses and capital answer what risk the bank absorbs. The engine converts those drivers into a decomposed break-even price, every component visible, so it can be challenged and reproduced. And a word on how wide that runs, because those three letters mean different things at different banks. The common reading is narrow. FTP is the funding transfer rate, full stop. That one does the structural work, lifting rate and liquidity risk off the originating desk and parking it with Treasury. This course keeps that job and builds past it to what we'll call the all-in break-even price. The narrow rate isn't replaced. It sits inside the wide one, still working. Only then comes the commercial call. The bank can quote or reprice the operation. It can also decline it or approve a transparent overlay. The model informs the decision. It does not hide it. Each layer gets a single sentence in this overview, deliberately thin, since all phases of the course live inside these layers. What matters now is the shape. The stack begins with the risk-free reference, the market time value baseline matched to the operation's cash flows and repricing. It isolates the rate reference before the bank's own liquidity structure enters the price. The next layer is the term liquidity premium, usually TLP. It pays for committing stable funding across the operation's life and for the rollover risk inside that term. Keeping it separate shows what comes from the reference curve and what comes from the bank's funding structure. Contingent liquidity is different again. It pays for readiness against stressed outflows and commitments that may be drawn when funding is scarce. Optionality prices rights held by the customer, such as prepayment and drawdown or contractual rate cap. Credit expected loss recognizes the defaults the bank expects across the life of the exposure. Operating cost adds what it takes to originate the product and keep it serviced throughout its life. Cost of capital closes the stack by charging for unexpected loss and the balance sheet risk that remains. Together, these 7 layers form the all-in break-even price, and commercial margin sits above it as a separate choice. So the stack is not a market quote, or said more precisely, it is a controlled synthesis of costs, each one owned somewhere in the bank. The break-even price is the economic floor. It tells you what the operation must earn before it creates value. A quote above that floor can create value. A quote below it transfers value somewhere else. The client rate can add a commercial margin, but that margin should never be confused with the cost generated by the operation. A strategic price below the floor is still possible. The difference belongs in a named overlay with explicit funding and approval, not inside a distorted curve. The first three phases build a foundation. They establish why FTP exists and who governs it, then keep the risk-free reference separate from the term liquidity premium. Phases 4 through 6 complete the price. Deposits and contingent liquidity come first, options and credit follow, before operating cost and capital close the stack. The final three phases put the framework to work, managing risk, operating the engine, measuring profitability, and steering the balance sheet. The last one is the longest. 6 worked cases end-to-end, a mortgage through to a whole acquired loan book. Then the committee table where those calls get made. Each phase closes the same way, a checkpoint, a few situations to decide with a written guide to each call. All told, close on 60 lessons, dozens of labs, something like 11 hours. Worth knowing what you're signing up for. Core lessons are the main route. Follow them in order, and completing them is enough to trace the framework from inputs through pricing and governance. Labs are recommended practice. They are Python notebooks that use the course engine to reproduce results and change assumptions, so you can see which outputs respond and extend or re-implement the engine yourself. They matter most if you implement or validate models. Deep dives are optional extensions. They examine calibration and alternative methods in less frequent situations. Use them when the extra depth serves your work, or return later without losing the core sequence. And whatever depth you choose, a full reference list ships with the course. Every source behind the numbers in one place. Before the first lesson, know what comes with the course. The calculator is the one to open first. It mounts the real pricing engine in your browser, gives you the operation and the bank's premises to set, and hands back the price broken into its layers. Change a premise, watch which layer answers. That's the whole loop. And the engine itself is yours. The same code prices the numbers on these slides, runs inside every lab, and drives that calculator. One implementation, not 3. Which matters more than it sounds. When 3 tools share one engine, they can't quietly disagree. Last, the assumptions register. Every premise the worked bank makes is declared in one place, each one traceable to the line of code that owns it. So when a number surprises you, and some will, there's somewhere to go and find out why, rather than taking it on faith. And one last thing, which shapes everything you're about to see. There's one bank. It's called Avalmont, and every number in this course is priced on its balance sheet. Not a fresh example for each topic, the same book throughout, seen from a different angle each time we add a layer. You meet it properly in the next phase, and by the end you'll know its funding mix the way you know a colleague's book. A calibrated archetype mind, not a real bank's disclosure. And every premise it makes is written down where you can check it. With the route clear, we can start where FTP starts, the problem it exists to solve, and the principle that keeps the transfer rate honest.